Sam has followed every money rule he hears. Save everything. Buy a home. Avoid debt. And trust only investments labeled safe. Each rule sounds responsible, but applied without context, several can leave him poorer, less flexible, or taking risks he cannot see. So let's test 10 of personal finance's biggest myths. Then replace each slogan with a decision rule that actually survives real life. Myth 1 says Sam should save every possible dollar while young because early investments have longer to compound. That part is true, but Sam's starting salary is low. Money spent on reliable housing, health, education, or career skills may improve both life and future income. A better rule is save consistently, protect against emergencies, and raise the savings rate when income rises. Compounding matters, but so does today. Myth 2 says a growing economy guarantees strong stock returns. Sam sees booming headlines and assumes shares must keep climbing. But markets price expectations about future business profits. Great growth can disappoint investors if share prices already assume something even better. Myth 3 says dividends create an extra return. If Sam receives $1 per share, the company has transferred $1 out. The share price typically adjusts for that payment. Sam should judge total return, meaning price change plus income, not chase dividends alone. Myth 4 says index funds deliver merely average results. An index is average before costs, but investors receive returns after costs. Broad index funds often charge less and hold the rare companies driving market gains. Most active large-cap U.S. funds underperformed the S&P 500 in 2025. Myth 5 treats a high Shiller cape as a crash alarm. CAPE compares prices with 10 years of inflation-adjusted corporate earnings. High valuations have meant lower long-term returns on average, not a countdown clock. Valuations can stay elevated while markets keep rising. Myth 6 says Warren Buffett proves Sam can beat the market by picking stocks. One extraordinary investor does not establish a repeatable strategy. Buffett himself recommended low-cost index funds for most investors. Admire the skill, but do not confuse an exceptional outcome with ordinary odds. Myth 7 calls cash and bonds safe. Their prices are usually calmer than stocks, which makes them useful for near-term spending. But inflation erodes cash, and rates move bond prices. Safety depends on the goal: stability tomorrow or purchasing power decades from now. Myth 8 calls gold an inflation hedge. Gold has preserved purchasing power across centuries, but Sam does not invest for centuries. Across ordinary horizons, gold can swing far more than consumer prices. It may diversify a portfolio, but it cannot reliably match each inflation shock. Myth 9 says rent is wasted. Sam's rent buys housing and flexibility, just as a restaurant bill buys food he consumes. Owners also pay interest, taxes, insurance, repairs, and transaction costs. Buying can win, but price, rent, location, and holding period decide. Myth 10 says all debt is bad. Expensive consumer debt can crush cash flow, but borrowing can also fund useful assets. The real test is its after-tax cost, repayment risk, and purpose. Leverage magnifies gains and losses, so a sensible margin matters. Notice the pattern. Each myth takes one true idea, like compounding, stability, or ownership, and stretches it into a universal command. Sam needs a system instead. First, keep emergency cash and adequate insurance, because a forced sale can ruin an otherwise good investment plan. Next, automate diversified, low-cost investing. Then, increase contributions as income grows. The exact mix should match his time horizon and risk capacity. For housing, compare total unrecoverable costs, not rent, against the mortgage payment. For debt, compare cost, flexibility, and worst-case repayment. Personal finance works when rules bend around goals, income, age, taxes, and uncertainty. A slogan cannot know any of those things. So keep the principles, discard the absolutes, and run the numbers.